We've got a financial analysis report on Beyond Inc., and it's making a very bold, bullish case.
Very bold. An 80% upside from about $6 to over 11.
Right, and the quantitative work here is solid. I mean, you've got this extreme 0.4x price to sales valuation, stable gross margins. It's a great starting point.
It is. But when you're calling for that kind of return, an 80% return on a stock the market basically thinks is going out of business, the delivery has to be perfect.
It's not just about being right.
No, it's about being believable. The rigor of the delivery has to match the rigor of the math.
And that's where I felt a bit of a disconnect right at the start. They're asking for belief in this, $11 target, but the tone sometimes feels like it's working against the argument.
It's that classic trade-off, isn't it? Engagement versus credibility.
Okay, so let's start there. The persuasive power of the analysis could be substantially increased by recalibrating the sense of urgency away from emotional language towards strictly numerical conviction.
This is the key weakness for me. The analysis has this really high-energy, urgent tone.
Yeah.
It uses phrases like, market is bleeding, everyone is panicking, smart money is looking at something else entirely.
It gets your attention for sure.
It does. It sounds like a headline, BBY to $11. But that's exactly the problem. It risks cheapening the institutional credibility of what is underneath a really solid financial argument.
The urgency is coming from fear, from market noise, not from the data.
And the data is already so exciting. The math is what's compelling here.
It is. So the suggestion really is to just let the numbers do the heavy lifting. Integrate that quantitative evidence more smoothly, so the urgency it comes naturally from the facts.
Right.
The conviction should flow from that insane disparity between the 0.4x price to sales and the competitors sitting at 1.5x to 2.0x?
That's the real story.
That dislocation is the story.
Exactly. If you think about it like you're building a legal case, you want the facts to convict. You don't want the lawyer yelling.
So for some concrete examples, instead of framing the dip at $633 as this emotional buy the fear moment,
Which it does.
frame it as what it is, a mathematically quantifiable moment of maximum technical dislocation. The report already notes the stock is testing support at $6.18. That's powerful data.
Use that. Lead with that.
And maybe replace some of those confrontational phrases like, it looks ugly, right? Wrong. Just stop telling the reader what to think.
And instead?
Just give them clear, objective statements. Contrast the market's perceived risk with the reality of, say, the $167 million in cash on the balance sheet.
So you put that cash number right next to the distressed 0.4x PS multiple.
And the reader gets there on their own. They conclude it's an opportunity without you having to shout it at them.
That shift in tone is critical. It grounds the entire 80% target in something defensible. So once we have that rigorous tone, what's next? How do we actually build the path from $6 to 11?
Yeah, that's the next big piece. It's the structure of the argument itself.
The report does a good job setting up the start and the end points.
It does. The start is 0.4x PS, priced for death. The end is $11.40, based on a return to normal and that 2026 growth pivot.
But there's a giant hole in the middle. 2026 is a long way away for an investor in a stock this volatile.
A very long way. And that brings us to the second point. The logical bridge connecting the current distressed valuation to the long-term $11.40 price target requires a clearer structural framework detailing the transition phases and intermediate milestones.
Right. The weakness here is pretty obvious. The analysis just jumps. It goes from the present state straight to that 2026 positive revenue catalyst.
And that leaves a massive credibility gap.
Huge. What happens between now and then? What are the specific interim results, say, in late 2024 or 2025, that will make the market re-rate this thing from 0.4x PS to something closer to 1.5x?
Before that 2026 growth even shows up on the income statement.
Exactly. It's like you're showing me a picture of base camp and then a picture of the summit, but there are no ropes, no map, no path in between. The climb just looks impossible.
It's a big ask. You're telling the reader to just hold on for 2 years and trust management guidance. So the suggestion for improvement is to add a transitional section.
Break it down.
Break that 80% upside into phased re-rating events. You need to tie specific near-term actions, like the cost-cutting they mentioned, or keeping margins at 25.3%, to specific valuation bumps.
This de-risks the whole claim. So for concrete examples, you could actually model the upside in 2 distinct phases.
Yeah, I was thinking about that. Phase 1 could show that just getting to a 1.0x PS multiple.
Which is still way below competitors.
Way below, but just getting there validates a preliminary price target. Maybe that's, $9.
And that's driven purely by stabilization. They keep the margin steady, they preserve cash, and the market breathes a sigh of relief.
The market re-rates it just because the bankruptcy risk, which is what 0.4x PS implies, has been taken off the table.
Okay, so that's the stabilization trade. Then phase 2.
Phase 2 is the growth story. Management's confirmation of that 2026 positive revenue pivot becomes the catalyst to unlock the rest of the target, the part that gets you from $9 to $11.40.
See, that provides a robust, defensible structure. It gives the reader measurable milestones.
It turns a hope into a structured expectation.
That flow is so much stronger. Okay, so we fixed the tone, we've built the bridge. Now what about the counter-narrative? The elephants in the room.
The risks. High volatility, insane short interest. The analysis correctly identifies them.
It does, but then it just sort of sets them aside. It treats them like a necessary evil, not as a core part of the thesis.
It's a very common mistake in these bullish reports. You see the disclaimer about risk, and you know they're just checking a box. They're not using that honesty to their advantage.
Which leads to our third main point. Fully embedding the identified downside risks and counterarguments into the core analysis will transform the bullish case from an optimistic projection into a robust, risk-adjusted thesis.
The weakness here is pretty significant, I think. By treating these things as afterthoughts in the conclusion, the report misses a huge opportunity.
A huge one.
It doesn't use the risk data to explain why the valuation is at a ridiculous 0.4x PS in the first place.
Nor does it explicitly connect the company's strengths, like its cash balance, to mitigating those specific risks.
The suggestion then is to flip the script. You have to turn the short seller's weapons into your own shield.
I like that. So you integrate the volatility and the short interest data right into the main valuation section.
Yes, you argue that these external market forces, this intense bearish pressure, are the reason for the valuation anomaly.
So you're not saying be careful the stock is volatile.
No, you're saying the price is at 0.4x PS because of the extreme short interest, and that dislocation is precisely where the 80% opportunity comes from.
Okay, that changes everything. It reframes the volatility from a scary warning sign into the primary indicator of the opportunity itself.
It strengthens the whole core thesis that this stock is fundamentally mispriced compared to its actual operations.
So how do you do that concretely? How do you use the company's metrics to fight that short thesis head on?
You reframe that whole discussion around the 0.4x multiple. State it explicitly. This valuation is not a true reflection of the business's health.
Which is stabilizing, based on the margin data.
Right. You say this valuation is a direct function of intense short pressure that has pushed the price far below its intrinsic value.
And then you build your defense. You use the internal metrics as a floor.
Exactly. You have $167 million in cash and confirms 25.3% gross margins. Use those to build a defensive wall against the short thesis, against that priced for bankruptcy perception.
If they argue insolvency, you hit them with the cash balance.
If they argue the business is collapsing, you hit them with the stable margins.
Now you've created a fully defended investment thesis. You're showing the reader you've already thought through the biggest counterarguments, and the model survives them.
And that makes the 1140 target much harder to just dismiss as overly optimistic.
You go from an enthusiastic pitch to a robust, risk-adjusted claim.
I think this really pulls the whole report together. Okay, so let's just quickly recap the high-level opportunities we've identified here.
Sounds good.
We started with a really strong quantitative foundation, going for that huge 80% upside. But the delivery needed some key refinements to make it truly compelling.
Absolutely. We landed on 3 big adjustments. First, it was all about the tone.
Right.
Calibrating that conviction so it flows from the data itself. Let that explosive 0.4x PS ratio be the headline, not the emotional language, that maximizes the credibility.
Second, we focused on strengthening that structural bridge, getting from today's price to the 1140 target.
Which means breaking the 80% return into 2 measurable phases. Phase 1 is about stabilization, maybe gets you to $9, driven by margins and cash.
And phase 2 is the growth confirmation, the 2026 pivot that unlocks the final target of 1140.